So welcome back to the third phase of manufacturing accounting. The recap of the second phase again, that's where I talked about the unrealized profits and the income statement. The first part for recap, final recap, I talked about the format of manufacturing account and I finished it at cost of production. So for the second part, recap again. Recap. Now, for when the factory department sends product to the sales department at profit, that profit is only realized when all the products transferred have been sold. That means at the end of the year, if there is closing inventory, which is a common thing, that means that will show that part of the goods sent that factory made profit on have not yet been realized. Example, in this case, factory incurred 20,000, but they charged 2,000 profit. So they sent it to sales department as 22,000. It is until when all the 22,000 goods have been sold that the 2,000 profit have been realized. So that means when there is a closing inventory, that means there is part of the profit here that is unrealized. And if you don't remove it or take care of it, we are going to be negating realization principle that says it is when goods have been sold, or when you have earned your income through sales, that you can show it as realized income when you have sold to customer. But when you haven't sold it yet and you have it as closing inventory, you have unrealized profit for factory department. The same thing goes for opening finished goods and closing finished goods. So that is, if you have closing finished goods, you calculate it using this way. That 1,000 here has in it 10% that was transferred. You remember 10% was transferred here. So it has 10%, this 1,000. So that means that 10% must be calculated. How do we calculate it? 1,000 is equal to 110%, because that 1,000 has the profit element. So the 10% we just cross multiply. 1,000 times 10 divided by 110. That gives us 90.9. The same calculation goes for if we have opening finished goods. That means this profit, this amount must have already included the profit unrealized by factory department previous period, which has to be calculated as thus. Supposing it was also charged at 10% factory profit. Should it be charged? If it was charged at different factory profit rates, you must take note of that. Examiner may tweak the information that last year it was charged at 15%. That means you are going to use 115. But this year is 10%. Or if it's the same thing, regardless, whatever the percentage given to you, that's what's going to guide how you calculate your unrealized profit. So opening unrealized profit goes here from opening finished goods. Closing unrealized profit goes to the left side from closing finished goods calculation. The difference between the two is charged as income statement. If there was increase, like in this case, it was 45 opening, it increased to 90. That increase is an expense in income statement, increase in unrealized profit. If there was decrease, for instance, as this was 45.45, if the closing was 40.45, that means there is a reduction of 5. That 5 is going to be an additional income. We add it to gross profit and factory profit. I believe you get that. Now I can move to the phase 3 proper, where I'm going to talk about the statement of financial position. So I'm cleaning this part. Statement of financial position states assets and liabilities and capital as at a date. So, assets, we can have factory equipment. Equipment of the factory is part of asset of the business. Cost, aggregate depreciation, the net book value. Cost minus aggregate depreciation is equal to net book value. Now, factory equipment, the cost will be given to you in the question, except you bought additional equipment. That cost comes here. Aggregate depreciation is depreciation you used in the factory overheads in step 1. Like this is step 3. Like this is phase 3. Phase 1, the explanation we gave for factory overheads, there is factory equipment depreciation there. That amount will be added to the factory depreciation in the trial balance in the original question to give you the total or aggregate depreciation. Cost minus that will give you net book value. The same thing goes for office equipment. Then you can have land and building, motor vehicle, every other non-current asset, bring it here. Cost minus aggregate depreciation gives you this. So you have total of this. And you show your current assets. Your current assets are the inventories. Now, the inventories, the closing inventories, there are 3. Closing inventories of raw materials, as we used in the calculation in the first video of this topic. Opening inventory of raw material comes here. I mean closing inventories. Let me say closing. Inventory of raw material. Also, work in progress. Remember, we took note of net work in progress in manufacturing account to get manufacturing cost of manufacturing. That opening, closing work in progress comes here. Then, finished goods, closing finished goods. Closing finished goods is still here. This is closing finished goods. Now, at this point, maybe your previous knowledge, you would have just taken this amount directly to it, possibly. But whether you know this is the amount or you don't know this, this is not the amount, I'm going to tell you the right thing now. Now, 1,000 here, you remember we said that it has element of unrealized profit. That means this is not the real amount. The real amount is the cost of it. What is the cost of 1,000 goods that it was transferred at plus 10% profit? Now, how do we get that? Basically, just deduct the realized profit from 1,000. You already worked it out here. So, don't do double calculation again. 1,000 minus unrealized profit will give you cost. Also, remember valuation of inventories. As we have done it also in this channel, valuation of inventories. You can watch it for reference purpose. For valuation of inventories, there is a rule that we should go with lower of cost and net realizable value to show the value of inventory. And want to show the value of finished goods. It shows closing inventory as 1,000, but the cost of it is what? Cost of it is 1,000 minus 90.9. Cost is 1,000 minus 90.9. Please help me to calculate it. So that's 1,000, okay, 909.1. 909.1. 909.1 is the cost. 90.9 is the profit. And it was charged at 1,000. So that means the lower of cost and realizable value is what? This is amount it was transferred for. This is the cost and this is the profit. Like 110% is it was transferred for 110%. Now 909.1 is cost, which is the lower of these two values. That means that is the amount we are going to show here. That means if we show 1,000, we are overstating the value of our assets. That is even not following the prudence concept of accounting. So also, realization concept would be negated if we did not show unrealized profit. So if we show the unrealized profit already, that's very good. Just take note of the cost of the asset, of the closing inventory. So our inventories, then trade, receivables, cash or bank, all that, add it, that's your current asset. Then you show your current liabilities. Your current liabilities are trade payables, then bank overdraft if you have overdraft, or if you have accrued expenses or prepaid income, they are all your current liabilities. So your current liabilities, when you deduct it from current assets, you get net current assets or working capital. So your working capital plus non-current assets gives you net assets. This answer is expected to be the same as your capital employed. So which is done in financed by. Financed by is your capital employed. The capital at the beginning, which is your opening capital, then you add the net profit we got here plus net profit, then you deduct drawings. This answer, you now add, the answer you get after you have added net profit and deducted drawings from capital, you now add non-current liabilities like long-term loans, non-current liabilities. The answer you have after adding non-current liabilities to this is going to be called capital employed. Capital employed. It's because of space, you are supposed to write it under this line and call it capital employed, which is expected to be equal to net assets. The main thing that we talk about as it relates to manufacturing is this and this. The depreciation, factory equipment is non-current asset, office equipment is non-current asset. Then how to bring about finished goods, inventory of finished goods. It is not this 1,000 anymore, but it is the cost of the 1,000 by deducting the unrealized profit off. The remaining amount is your cost. Also, which just for emphasis in case you already know, for trade receivables, the trade receivables value minus the provision for doubtful debt for that year. And the final answer for net assets will be equal to capital employed. In case you have any questions, please comment with the question. I'm going to react to it. I'm going to attend to it as soon as possible. I hope you enjoyed this topic and keep watching this topic. Sorry, keep watching this channel. I need to take water. Enjoy the rest of the day. Bye. And credit to Michael. That's Michael. There's another person at the background. She's told by name, but she's showing behind the camera. Thank you very much.